When it comes to banks versus venture debt funds, private credit funds, mezz lending, whatever you want to call it, there are some very distinct differences. What you'll understand first and foremost is the cost. Private credit's always going to be more expensive than a bank. They have their own investors that they need to report to. As a result, they take higher risk. And you tend to have less reporting requirements. You don't have the requirement to bank with that private lender typically. So what'll happen is with a private credit, you're going to pay right now, it's probably somewhere in the neighborhood of 30 to 35% more as far as all-in cost of capital on a typical venture debt style loan than you will with a bank. A couple years ago, that was probably more in the 60 to 65% increased cost of capital. But companies over the past few years have really been leaning that way due to the flexibility. You have funds out there that will do little to no covenants. You do not need to move banks if you're not banking with that lender because a private credit fund isn't a bank. As long as you're working with a bank that's friendly with U.S. lending laws, you have your options and your pick of the litter there. Banks, on the other hand, they're your lowest cost of capital. They do offer broader services than a private credit fund will. So if you're looking for something that is truly, I just need the capital, I might need some support along the way and some advice, private credit is your route. If you are heavy on liquidity already, if you are a high growth company and you are interested in things like treasury services, FX, and all these other services that a bank can offer, bank might be more your route. Banks can be really good for companies essentially who don't really need the money but would like that insurance. Private credit is where you go, where you're looking for a little bit more capital, typically as a replacement to an equity round, and you're willing to pay for it.